So first of all, thank you and welcome to everybody in the seventh talk of Senora Advisors. This is the part of the Senora Saturday Talk series where we try to cover topics impacting the financial health of investors and the broader community. As a part of today's discussion, we'll discuss the result season Q2FY23 and performance of Senora's flagship fund Alpha Plus. With me on this webinar is Mr. Kunj Bansal, a stalwart in the market. His role
Yeah,
is
hello everybody.
that of an independent advisor with Senora, where he overlooks our investment process and tries to red flags if we are missing anything or if we are doing anything which he believes is not in the best interest of our investors. Kunsa, you want to start with a brief introduction of yourself? While I am sure most of the audience will know you, but if we can do that.
Yeah, so just as an introduction, I am an engineer and an MBA by qualification. Have been in the market for now. I told somebody 30 years. He says, no, say it like you have been there for 3 decades. So that looks better. I said, okay. So I've been in the market for 3 decades and I have seen almost 5 cycles of ups and downs. So that has its own advantages and disadvantages. Advantages is that you have the experience of seeing the irrationality of the market on both sides, upside also and downside also. The disadvantage is that in all the new generation industries or stocks that keep coming in, sometimes I get biased by my old valuation benchmarks that no, beyond this a company cannot get valuation. That certainly doesn't happen in short to medium term, but yes, in long term we see those corrections coming in. So that's how it works. And very kind of you, Mridul. Let's take it forward.
Perfect. So this was a very important quarter where the headwinds of inflation, talks about recession in various parts of the globe, equities underperforming, bond yields going up, created a lot of concerns and challenges for the investors and asset managers. Hence, the result season became equal. While there is no undermining the importance of the result season, they become very, very important for us to understand what are the corporates doing, what are the management thinking, and how do they plan to take this forward. And trust me, at least for Team Senora, this result season was quite in line with what we thought, that the impact on Indian companies will be the least among the global peers. Some of the global companies continued to reel, and I'm not going to discuss about them because that's not under the purview. Let's discuss the Indian markets. And within the Indian markets, I think broadly all sectors and corporates kind of delivered returns which are either in line or better than the expectation. We at Senora are heavily invested in 4 sectors: banking, IT, auto, and consumer, and we will discuss them in a slight detail, and then we'll talk about the broader result season. And we'll move into the second part, which is the performance of our flagship fund, Alpha Plus. Kunsa, that's a perfect way to go forward.
Yeah, I think that's a good sequence for
Okay.
today's event. Yeah.
So let's just start with the flagship sector, the banking. I think the king of all the sectors when it comes to markets. So banking sector had one of the best quarters in my recent memory. A quarter where there was a robust growth in the loan book, in the NIMs, in the NIIs, and a quarter with least impact when it comes on the asset quality or slippages. I think this combination we are seeing after ages, and that got reflected in the strong outperformance of the banking sector. While for the whole year the markets may not have done much, if you look at the data in last 6 months, banking index as such is up 27%. That's a huge upside for our index level. And the quality stocks are obviously up higher. So let's look at the summary and then we'll look at the reasons for the summary. So one of the best quarters in the recent memory, as I told you, on an average, the sector witnessed a growth of 5% Q-on-Q loan growth with 20 bips expansion in NIMs. The expansion in NIMs came because of the 2 hike which RBI did during the quarter. Now, in the banking sector, typically the lending rates get reset faster than the deposit rate. As a result, in a rising interest rate scenario, we get a better yield on the lending side, while the liability side transforms over a period of time. The asset quality was better with slippages and credit costs coming down for quality banks. Why I mention quality banks is because the quality banks improved a lot better than the others. Among the banks, Axis Bank reported the best improvement along with Bank of Baroda and other PSU banks. PSU banks gave amazing profitability and much lower credit cost. Kotak and HDFC Bank, the stalwarts and so-called the defensive lenders, they didn't excite the market because they are more cautious in this environment where the way the global are going. And with the aggressive banks or the banks who are improving, eating into their coming back and eating into the market share. We believe the trend will continue, and it seems the market also believes the same, as the banking sector is the best performing sector, as again highlighted. Senora is playing the banking sector with ICICI and SBI. We had Kotak in this quarter, but as we speak, Kotak is out of our portfolio. We have replaced that with Bank of Baroda. Uh, so why did banking sector did so well is because if you look at the government policies, if you looked at the way the corporates are talking about, and they are confident of the growth coming with least impact on the asset quality, which makes them go aggressive and look for growth rather than looking to control to get their house in order. And this gives the confidence to the bank, and they start giving better numbers. Kunsa, you want to add a couple of lines here?
Yeah, sure. So you have rightly started off, Mridul. Uh, just to add to what you said, the credit growth in the whole banking space, or rather in the economy, the credit growth from the banks has gone up from a low of mid-single digit 6-7% that it had reached post-COVID to 17-18%. Now that's a huge jump. In fact, not only that it's high from the post-COVID, it's almost a 9-10 year high. So
Yes.
that reflects the kind of activity that's happening in the economy.
It's for me, it's a combination of the health of the banks that allows them to look for growth. And the other is the fact that the policy paralysis which India has been going through has come down a lot. This, along with the fact that so much uncertainty into the global, especially this China one story, the larger corporates are looking to invest into India, build capacities into India, which is where the credit growth should come from. So this time the credit growth, as you rightly highlighted, has not only been retail credit growth of the past, it has been wholesale credit growth. And it
Yes.
seems this is quality wholesale credit growth. So typically we have been growing at single digit credit growth or maybe early double digit because retail cannot grow more than that, frankly speaking. And corporate credit growth सिर्फ inflation वाला होता था, उससे ज्यादा कुछ नहीं होता था. So this time we are seeing the credit growth because of for retail plus the inflation rate working capital credit growth. We are seeing fresh credit growth also. And that is why all of the sectors participate, not that one or two banks grow extensively and the others are still laggard. So it's like all cylinders fighting for the banking sector in this quarter. Now let's move to the second sector, second part of the banking sector, which is the NBFCs and the non-lending companies. So while the banks had the best of the time, NBFCs had the other side of it. Typically, what happens is NBFCs lend at a higher rate to banks, and they kind of segment to the banks where the banks are not lending, or they go aggressive because the banks do not want to go on the aggressive loan side. But with the rising interest rate scenario, their cost of fund goes up because these NBFCs typically borrow from the market in terms of bonds and debentures, or they do it through banks only. Hence, their cost of borrowing gets reset faster than their asset side. Most NBFCs, while reported a strong asset quality, but the margin and growth was disappointing. Bajaj Finance and Chola, the best of the NBFCs, actually stood out among others. HFCs had the worst hit when it comes to the margins because HFC operates on a very low NIMs, and any cost of increase of funds hit their NIMs very aggressively. This kind of impacted the numbers of LIC housing among others. In this space, Senora prefers Chola, and we are invested in Chola. If you look at the insurance companies, I think all the insurance companies, it was business as usual. There was nothing exuberant on either side. The good part to be noted was the claims because of COVID over the last 2 years is tapering down, and hence their profitability was better. The performance which stood out for us was LIC. LIC, which got listed around a couple of quarters back, last quarter reported a very subdued kind of a number, but this quarter they reported much higher profits and much higher growth to the peers. We will look at these LIC numbers for the next 2 quarters also closely. If they continue to show the kind of leadership ability they have, then it will excite us, and we believe that this will excite the investor community as a whole also. Asset management business, we have few asset management companies now listed. Sonora actively doesn't track any of them. I don't broadly looking at the results, I didn't find any of them too exciting. Kunsa, do you want to add something there on the AMC business side?
So AMC is something which will we know all that will remain an annuity oriented business. The growth expectedly has come significantly low single digits, 2, 3, 4% kind of thing, which is what it will remain. Of course, it will be a function of, so in a particular year, if the asset growth suddenly goes up 10, 12%, then the fees more coming from the equity assets will also grow up. But pending that, it will continue to remain this kind of business. The only thing to be seen is that this will be a high dividend payout business, not necessarily high dividend yield, but yes, the kind of, especially the larger AMCs, which are almost all top 4-5 listed companies, make the profit in the range of 100 to 300 crore, and they are not capital intensive, so they don't need the money, so they should be easily paying out 70-80% dividend payout.
Agreed. That's the point which we should look for, because I think by penetration we are done with the penetration in the asset management business. By the concept, the distribution has reached every kind of reachable village. Also, if you can talk about through post offices and others, this business doesn't require the kind of working capital as other businesses do. So yes, there should be cash throwing cows and should trade at a FCF valuation rather than anything else. So I think we both kind of agree there.
Yeah.
So, but again, the part which Sonora looks for is whether it's insurance or asset management businesses, we will get excited about them only when see one player outperforming the others, which is if the sector is growing at N percentage, we can only invest in a stock if we believe that that will grow at N plus 3, N plus 4% more, which is 300, 400 bips more, or will throw better margins or better cash flow than the others. So far, we have not able to find a drastic different from the peers in either of the sectors. We believe both the sectors are good with healthy balance sheet and everything, but nothing exciting to create that delta or alpha in the portfolio. If that is to be shared as our view. Let's come to IT sector, the sector which has been the talk of the town with so much about global recession and valuations and everything. Let's look at the overall sector first. The demand remained buoyant while margins have stabilized after being dropping heavily over the last few quarters, but it remained below par. The margin improvement which we expected didn't came across every player in the sector. Some players reported a better improvement. Overall, the deal wins were lower than the past, but much better than the feared, as the management sounded confident of negligible impact of recession fears. The management sounded continuous addition of clients, deal wins, while obviously the pace was lower as the larger corporates are also seeing this phase where high inflation, high interest rate could hit demand, and they will be going cautious on their discretionary spend. With wage hikes done and attrition coming down, we expect the margin trajectory to improve for larger players from here on. But with the discretionary spend is slowing down, the companies may no longer grow as fast as they were going. But companies which have a longer period of contract, which is like Infosys typically does a 5-year, 6-year kind of a contract when they do a large deal. These companies will do better. But do you remember when the cost was increasing, these companies reported a worse margin trajectory compared to a mid-cap IT, which looks for a shorter period of a contract. So what we believe is going forward, there will be a a change of trajectory when it comes to the large caps and the mid cap player. The large cap players will show a better revenue growth with improvement in margins as the cost pressure comes down, whereas the mid cap companies will not able to go a similar revenue growth, and with revenue growth is slowing down, the margin levers are going to also impact negatively, and hence their earning trajectory will not be same as the large cap player. That is what Sonora believes. While we look at the valuations have now become attractive both on a long-term mean perspective, recent correction, and ownership perspective. But without any positive trigger, we don't see the stocks outperforming the market. We believe it will remain into a consolidation and a range bound. What can be the positive triggers? The positive triggers can be lower bond yields, which we have started seeing in US market, and margin improvement in the coming quarter from the players, make which will lead to earning upgrades and lead investors to buy it more. In this space, we prefer Infosys and believe that there is more pain in the mid cap IT space. Kunsa, you want to add some input here?
So what I am looking forward to is that, yes, you have summarized the gone quarter well. Will there be a sequential improvement in December quarter, or if not in March? Growth, of course, as you rightly said, that probably could continue to be an issue because of discretionary spend cautiousness. But margin is something I would like to see going forward
Yeah.
sequentially.
So if this quarter, if in the coming Q3 quarter, if the margins don't improve sequentially, then I think think the whole story may see a down
Yes,
rating.
sure.
Whereas if the revenue growth is better than this quarter and the margins are better, I think multiples will see an upside. So yes, coming 2 quarters are very, very important for this sector. Auto and auto anchors, the sector which has been the talk of the town along with the banking sector. So this quarter, Q2 quarter, typically is a build up to the festive quarter, which is the Q3 quarter. So volumes have been more or less remained stable as global makers face the inflation heat. While commodity prices have corrected from the peaks, full effect is not getting reflected. While margin improvement was seen in this quarter across all major players, we believe the trend will continue in the coming quarters. M&M continued with its new launches in the SUV segment and have done well with festive demand building looked good in the data when it comes to the numbers. And if you look at the monthly numbers or the festive season not being over, the sales number has been better than the expectation. I think chip shortage is a history now for most of the players when it comes to the auto sectors. JLR continues to be an issue for Tata Motors, which is again on the expected lines because the way the global economy is working, we don't see JLR surprising upside much. While the chips issue gone should improve the margin, but FCF is still some time away because of the lower demand in Europe. However, that's the place we want. Tata Motors is a place where we want to play the domestic EV and the CV space both. Going forward, the new product launches from Maruti and constant improvement from Tata Motors would help us keep the interest high. We are playing this sector through Tata Motors and Maruti in the auto segment, and Maruti Wireless, the India business, in the auto end segment. We sold out of the Maruti Samvardhan, which is the global business, in the month of October. Kunja, you want to add something in this point?
No, I think on auto you have covered it fairly well. I don't have any additional observation.
So consumers, high commodity prices was a spoiler, which was again on the expected line. Consumer sector typically grows has two aspects. One is the volume growth and the other is the price growth. Price growth typically is driven by inflation, while the volume growth is where we look for the demand part of it. The volume growth numbers broadly for the sector was nothing exciting except for Britannia. In terms of price growth, I think the companies took most of the inflationary pressure on the price part, and hence the revenue growth looks good. While because of the high input prices, high inflation, their margins was a bit disappointing. Broadly, the results were in line with the street expectation, not much surprise on either side. ITC outperformed the consumer space because the cigarette, which is least impacted by the inflation, reported healthy volume growth, and agri and hotel division also did well for them. Rural is still reeling under pressure, whereas urban is relatively better placed, which is on the expected line. The what we feared during the earlier quarter is now also playing out as the consumers are doing downtrading to lower SKUs because of the increase in the cost. That was reflected if you look at it in the numbers of page, in the number of other discretionary spend, where they felt the reel around it. We believe that uh, if the inflation remains high, this downtrading will continue. Zomato report, which is an aggregator and not a manufacturer, reported a very good set of numbers with the food delivery business generating positive EBITDA for the first time. The company seemed confident to report to continue with the trend going forward. We expect Zomato to become a FCF positive company over the next 6 to 8 quarters, and that for me will be a big game changer when it comes to Zomato. We are playing this space through Zomato, and we have in the month of October we sold out of ITC and bought into United Spirits. Kunsa, you want to add anything here?
So one just an addition that in addition to ITC's good cigarette growth, even the other cigarette company Godfrey Phillips also reported very good growth.
Yes.
So it's the industry which is growing.
Yeah.
Two, the Britannia numbers surprised. I mean, that completely outperformed the industry in terms of top line growth. I don't know the reasons, but yes, while the whole industry has had single digit, mid single, low single digit, Britannia had a very good growth.
So that's a stock which we have put under our observation list, because
Sure.
as I've told in the past, as I have highlighted in the previous sectors, that when a company within the pack starts growing better than the pack and is a market leader, it excites us because we believe then we will get both a better revenue growth and a higher multiple growth. So Britannia has been a market leader, but it hasn't delivered the same quality numbers as others. So was this quarter a one-off, or is this the start of a trend? We will be watching the next 2 quarters very closely. So
Sure.
LIC and Britannia are the two results which we picked where we want to observe going forward. So this broadly puts us to the end of the sector discussion. Kunshar, as the last time, do you want to highlight any result which we haven't covered or which is not part of our universe and worth looking at, like Britannia and LIC within our universe and space?
Yeah. So yes, we have broadly covered, especially all the sectors that are in portfolio and in general other noticeable results. One sector, which of course is not part of the portfolio and probably sometimes gets valuation, sometimes doesn't get, cement sector. Now, of course, because of the not recent now, maybe few months ago, corporate action, Adani Group entering into the cement sector, suddenly there are two schools of thought. That will it result into the whole re-rating of the whole sector, or will it result into only the Adani Group company going up and the others not getting valuation? But keeping that aside, in terms of quarterly numbers, just like we were discussing IT, that is a sector that again would be monitorable, that sequentially the margins would they start to improve in December, in March quarter. In my view, possibly yes, in terms of the raw material prices, the pressure of that, and as a result, EBITDA margins falling almost 70-80% compared to the earlier quarters, was probably the bottom for margin for cement quarter in September, and December and March we should see that improvement. Other than that, I think we have broadly covered all the aspects.
So for the benefit of the audience, Senora investment team is in line with what Kunsa said, and in the month of October we moved out of Wipro and we bought Ambuja Cement because we are also very bullish on the cement space. The reason we bought Ambuja ahead of Ultratech is because we believe that with the change in management over the next 4-5 years, you will see aggressive expansion from Ambuja. And this space is all about expanding and growing capacity and having a better utilization. Along with that, because of the dynamics of cost control through power and logistics, which Ambuja can bring on the which Adani can bring on the table for Ambuja, we believe the EBITDA per ton improvement for Ambuja will be better than Ultratech going forward. And that's why we believe that Ambuja will report a better earning growth than Ultratech. But yes, we looked at Ambuja and Ultratech within the cement space, and we at Sonora, the whole team believes that cement is a sector one should be invested in. So that's a point which again where we both agree there.
Sure.
So let's look at the critical part of it, that all the gyan and then आखिर performance क्या है. So our flagship fund, Alpha Fund, where we manage clients' money, let's look at that fund. What happened during the quarter? Stocks which are already part of the portfolio and where we kept adding more are is Bharti, Kotak at the start of the quarter, Infosys, Maruti, and Tata Power. Please note that Kotak we sold out in October because when we did our work, we realized that Bank of Baroda is a better bet. And among the banking, what we found is that SBI, ICICI, which we hold, are better bets than Kotak. So we moved out of Kotak and added Bank of Baroda. This is our model portfolio and the performance. Since inception, which is May 2019, our XIRR return is 33.1%. Comparable Nifty returns are 16.7%. We had our XIR is 21.7. This is the model portfolio return of 33.1. Our Nifty, we have done a Nifty XIRR is 13.2. Our XIRR is 21.7. Our top holdings are Bharti, Maruti, Infosys, ICICI Bank, and SBI. All of them are more than 10% in the portfolio. Please note, we do not include dividend which comes into the client's bank account as a part of our performance at any point of time. These are the stock movements. When I say stock movement, I mean how our stocks have done relative to the Nifty. So the best performing stock for us in this quarter was obviously ICICI Bank, Bharti, Chola, SBI, ITC. The performance we are talking about here is, please note, is from 1st of July to 30th of September. During this period, our portfolio grew by around 6.5%. This was an underperformance of 1.5% to Nifty. The daggers in our portfolio was Infosys and Wipro. We took a small bet in LIC in our model portfolio, which has also not worked. So that has been one of the underperformers. Samil here is the Samvardhan Motherson Sumi. Wipro and Samvardhan are not part of the portfolio in the coming quarter because we exited during the quarter. This has been the performance of our fund relative to the Nifty since inception. As you can see, barring 2 bad months, we have been on the green side more rather than on the red side. This is the performance of Sonora's NAV versus Nifty NAV. The what you see in the block is the weightages of Nifty stocks in Sonora's portfolio at the end of each quarter. So as you will see, we are very heavily invested in Nifty stocks, and that's why we compare ourselves with Nifty. So that was a brief on the performance. Happy to take questions. Kun sir, you want to start by asking some questions around, and then we'll open the floor for our audience?
Yeah, sure. So anything that you are, although we discussed this point during the quarterly result review, anything that you are monitoring in terms of sectors or even stocks, if they can be disclosed for potential inclusion in the portfolio as an outcome of quarterly performance?
So not as an outcome of quarterly performance. Let's say stocks like I told you, LIC and Britannia were looking to add. They were stocks which are in our radar since last couple of quarters. Bank of Baroda, United Spirits. We added them in the current quarter, in the month of October, by exiting Wipro, Samvardhan Motherson, Kotak Bank, and ITC. What we also added was Ambuja because of the change in the promoter and the change in the earning trajectory which we expect to see going forward. So these were the changes we did. And we came out with a note to our investors where we said we did a note called changing gears or shifting gears with a portfolio
Yes, I
reject
saw that note. Yeah.
where we did around 18% of the portfolio reject. Now we are not a churners. Our annual churn would be like 0.665 types, but we do structural change churn when we see a reason for it. So this was a churn where we kind of added beta to the portfolio. We added aggression to the portfolio because we expect better earnings from these stocks.
Sure, we can take questions if there are any from others.
Okay, so we'll wait for 2 minutes and request audience to put their questions in the chat segment. Me and Kunsar will be very happy to answer that.
So there's first question which has come asking view on pharma sector.
So unfortunately, pharma is not part of Senora's universe. We we are very candid and humble to accept the fact that we don't understand pharma. We do not want to invest in any sector or a stock where we do not understand the same, and which is why we do not invest or discuss pharma. Kunsar, if you want to share a view, happy to pass on to you. Else we'll move to the next question. Because
Yeah, so
while I
very
might have a
briefly,
personal view, I will not put it on record because it's not a worked upon or research to you.
yeah, so very briefly, more as an observation on sector and not necessarily a research or an insight. Generally, we see that when a sector outperforms, uh, uh, initially the leaders start to do well, then followed by mid cap, and then even the smaller cap. And same happens in an underperformance. Almost all companies start to underperform. Pharma sector is one where there are completely divergent. So whereas there are companies which have done really well, obviously in financial performance, leading to their stocks doing well, like Sun Pharma and Cipla. There are others which are completely at the bottom. So it's a sector which is not, in addition to being difficult to understand, very technical oriented. So one really needs to have an insight. It's something where it is very difficult to take a sectoral view. Number one, it's more of individual views. Two, the pressure of the US market pricing power not being there, it started some time back and has continued. I think now it's almost 8, 9, or maybe 10 quarters since this issue has been haunting the exporters to the US. The second thing which happened is that last year in the same quarter, there was a lot of COVID oriented product sales by at least some of the companies who had COVID oriented products. So they obviously have reported year on year basis degrowth in that businesses. So just few observations, very difficult to take a sectoral view as a whole and to give a very going forward what will be the view.
So my only observation, and I am not sharing a view, I'm only sharing an analysis here, is the fact that typically pharma sector does well when the US part of the business grows with a margin accretion. As Kunsar highlighted very rightly that over the last 8, 9, 10 quarters, we have not seen that. So until as the US leg of the business starts firing, we don't see pharma sector firing. And typically domestic pharma is a very, very fragmented market. And they are a steady state things. And I think beyond the point, डोमेस्टिक फार्मा में कोई प्लेयर बहुत ज्यादा नहीं टूटा है. अगर किसी का कोई स्ट्रक्चरल इशू है तो अलग बात है. But it's whatever pain in pharma has been there and seems to be continued at this point of time is because of the lack of US business visibility. So that's the only contribution we can do on the pharma sector. Sorry about that. The next question is, can you discuss the core reason for selling ITC? That's a very good question, and I'll go a bit back on this and say the why we added ITC. I think that will have the answer of why we sold ITC also. So we added ITC in mid 2021 at around 240 rupees. The reason for adding ITC was threefold. The first was The agri business was reaching considerable revenue and started contribution decently to the EBITDA. The hotel business we expected to start firing with the lockdown playing out. The IT business, we became bullish on IT in late 2020, and we saw that continuing in 2021. ITC through ITC Infotech has a decent exposure in IT business also. So we realized that the revenue growth, while it still is very dependent on cigarette, but both revenue and EBITDA growth will see contribution from other businesses also. And these businesses should trade at a better multiple compared to the cigarette business. And hence, overall, there will be a multiple re-rating along with revenue growth for the ITC business. That panned out. Along with that, there were talks of management about doing demerger and stuff. We believe that that will also trigger some multiple re-rating. This as a combination led to a 40% outperformance of ITC to the market. And at when we entered, we had a target of 350, 380 on the card. And when 350 came, we decided to exit, saying that we are happy to leave the last 5-10% of the table because we have found another idea which is equally exciting for us. So what we believe is the upside trigger in ITC from here on will be demerger only. Most of the other things are in the price. Hence, and while we can expect a similar return, what we got in ITC over the last year in United Spirits, and hence we shift out of ITC to United Spirits. Please understand, we are kind of advisors where we work on a concentrated portfolio, and we do not believe in the model of holding more than 12 to 18 stocks. Hence, if I have to add something, I either will have to trim something out. And hence, we do that balancing act where we judge both of them and see where we see more money. So the answer is in two parts for selling ITC. One is the analysis I said, and the other is the fact that we found United Spirits to be a better bet. I think I covered the point, Kunsa, which we discussed when we did this switch.
Initial part.
Yes. Thank you. Let's move to the next question. What will do well in election minus year in 2023? I think the biggest point which I will look for from the government is that if you look at the last budget, the government hinted for the first time that they are going to focus more on growth rather than welfare. Welfare means giving free money to the community. The government did the welfare part in 2020 and 2021, where they compromised on the fiscal deficit to give food and basic necessities to the people in the tough times. And the Indian government never went for printing money to do the welfare of the well-off people. Having said that, the last budget they gave the sign that they want to spend now on the growth and infrastructure side of it. And hence, we believe that they want to go to the election year by showing work and not distribution of money. So planned expenditure and unplanned expenditure, the famous segment, we believe the spending will be more on the planned rather than the unplanned sector. We believe that road infrastructure development will remain the part of it, reforms will remain the part of it, and that's why we have added cement as a play. We believe, which is where we believe the credit growth will remain good, and hence banking sector should do well. So we continue to believe that government will focus in election minus year on growth, and hence while fiscal deficit may remain slightly on the higher side, but we don't see unplanned expenditure moving much up. Sir, your views?
I think you have covered fairly well. Nothing to add.
The second question in the same person is, Reliance, do you think can be a dark horse in FMCG sector? They are very aggressive through their private labels, plus very recently pushing milk basket. It's like Blinkit. I think when I look at a Reliance as a stock, these businesses are too small in contribution to revenue, profitability, and EBITDA and everything. And even from a CWIP perspective. Typically, whenever Reliance enters a new sector, they become a dominant player. But they take 4, 5, 6 years to do that because they follow a typical process. Be it Reliance Retail, be it Reliance Jio, these two, they are a major contributors now, but they started investing in those business maybe a decade back. So this is too early to talk about those businesses. There's a lot about the financial services part of it also. I think when Reliance gets into business, they want to become a major player, but it's quite a time away. So will that move Reliance stock? I don't think so. Will that contribute to Reliance earnings over the next 2-3 years? I don't think so. Are we watching these developments? We are keeping an eye on this development, but they are not going to be game changer for us. Kun sir?
Yeah, I think again you have fairly covered it well. Nothing more to add.
During the presentation, we refer that Senora team will wait for Britannia to show the consistency in numbers. By then, valuations will go up. How to deal with this? That's the point. And that's a very, very valid question. Sir, I will want you to answer that first, and then I'll say our thoughts.
Sure. So what happens is when a company, or even before a company, even a sector, moves into consistent improvement of numbers, the outperformance period can last anywhere from let's say 1.5 year to three and a half year. So yes, you will indeed miss the initial part of the rally, but then it gives you more confidence. So it's a toss off between buying something which you are willing to bear underperformance, or a sudden change, as Mridul pointed out while highlighting that, was it one off quarter or will there be a consistency? If it was one off quarter, we'll again see the stock coming down and resulting into underperformance. So while the question is valid, in terms of answer, it's a toss off between doing let me say contra investing, wherein you are willing to bear the opportunity cost for a longer holding period of time if the consistency doesn't come, versus watching it for some time, getting it into little higher, letting the initial part of the rally go away, as a result protecting yourself from the expected underperformance also, but then riding on the remaining outperformance.
Very well said, sir. I will add 2 points to it. One, the toss between the two ultimately taken by an investor or an advisor is based on the analysis, precedence, and the gut of the person. Now, Britannia is not a new company. The promoters are not new. In the past, they have disappointed the investor community a lot. And hence, they will have to do a lot more better to get rewarded in a true sense. While the recent move is justified because of the numbers, I think one bad performance and the fall will be much more in the stock than what it went up. So given the risk of the downside, I will want to buy only when I'm sure it's a winner. While it may not go up immediately if I get into it, but if the performance is structurally good, then the stock has a long way to go. And hence, as Kunsa pointed out, I'm happy to let go of two quarters of gain for a next 6-8 quarters of benefit. In some cases, we have taken that call and ahead of time and benefited from it, like we did in Tata Power last year, where we saw the things changing much before the market. And when the things actually change, we got rewarded much better than the market. But that is the difference between a Tata management and a business model. FMCG in the food segment is a very competitive market. Is it just an anomaly where they did well in one quarter, or is it that they have started doing something different from the peers and will continue to do well? We need to be more convinced before we buy it. And if it runs up too fast before we can analyze and do it, we'll let go of it without worrying about it. It happened in M&M. We liked M&M, we saw that trend changing, but by the time we could be convinced, the stock went up much ahead of the curve, and we don't own it today. It's a name which we like, but we can only enter now if the stock corrects and comes to our comfort level. The next question is, what is your view on Zomato? Good results, yes. Yet top three executives of different verticals have resigned in 15 days after the result. How important do you think is to keep top executives in your company, and how do you see Zomato shaping up from here? So 2-3 parts of it. All the three guys who left the company played a very pivot role in building the verticals for Zomato. Yes, they were three very important executives, and came to a surprise to us, especially the last of it, which got announced yesterday. But if I pull back and think, then I see that Zomato is more or less done with the expansion and the penetration part of it. If you read the last two newsletters of the promoter or the management team, they are saying that here on they will not burn at the same rate because they are more or less done with their expansion to 1,000 plus cities. Hence, it's more about execution rather than expansion year on, where I think different people will play different roles. So maybe while I will not want to make the same comment for Mohit, but the other two may have played the important role in building that up, and hence with that being done, they might find a better future for themselves in another startup. And please understand that this is where the startup culture comes from. These entrepreneurs at startups are very young people, and they aspire to grow. Zomato is done with the expansion growth and now will do the execution growth. So which entrepreneur or which part of the entrepreneur team wants to do execution and which wants to do expansion is where the call comes into the picture. So yes, we are watching that very closely, and we'll watch the performance very closely to see the impact of these exits. But because Zomato is now more about an execution story rather than an expansion story, we don't see much downside because of in terms of business because of these exits. And please understand that they have reached a scale where it's all about operation and execution and not anything else. So it's like reaping the benefits of the investments which you have done over the past 10 years. How important it is to keep top executives in your company? That's very, very important. But what role each executive brings becomes equally important. And in case of Zomato, we are still to find that out because it's a relatively new company, young company in that sense. How do you do Zomato shaping up from here? We are super bullish on Zomato because now it's an execution story and not an expansion story. Kunsar, you want to add some views?
No, I think Zomato you have been covering in far more detail than I have been. So you have taken it up rightly.
Thank you. A follow-up question to the previous question is, how does this impact Zomato? So do you think one should build the business is not important for execution? Building the business is like building the foundation. So it has to be the important part. But please understand that for us, Zomato is done with building the businesses. It's about monetizing them through execution. What is important, and even we do not have an answer yet, and we do not want to preempt an answer here, is whether these guys were playing an important role in execution also or not. We'll wait for clarity on that before jumping the gun. Execution and building a business are two important pillars. Building the business comes first, execution comes second. Zomato is in the execution phase now. What EBITDA do you see in next quarters in Zomato? Sorry, we do not put models and predictions on numbers in public space. All we can directionally say is that Zomato's food business, which was negative EBITDA company, negative EBITDA contribution till now, should become a positive EBITDA company. Management has guided for a 3 to 5% positive contribution from the food business in EBITDA space. We believe that the company will not only reach that, but may see a higher side in the coming years, if not in the coming quarters. Unlike a sell side, we do not discuss numbers or EPS or growth. We discuss the trajectories of it.
Yeah, I think we seem to are done with all the questions
We
at least as of
will,
now.
yeah, we will just wait for a couple of minutes for more, else we'll say thank you to our audience and obviously a thank you to you, Kunsar.
Sure.
While we wait for it, why don't we summarize this by sharing our views on the market? Kunsar, I will let you start, do that, and then probably I'll add my bit to it.
Sure. So you know, sharing the views, trying to predict the market, and all these things are always difficult, and one invariably goes wrong then right, especially in the short term. But nonetheless, we are market participants. It's our job to keep analyzing and trying to understand. The way to start is to look at the current macro numbers and developments and market movement itself. So in terms of movement, if we see last 1 year, in fact now 13 months, October 21 is when we had peaked 18,000, reached the peak 18,500, and now we are currently back again close to that. In between, we have had almost 4 rounds of up and down. The recent lows was first in June 2022, and then again in September last week or so. So even from the September last week to today, we are up 7-8%, maybe closer to 10% also. Along with that, if we look at the macro numbers, finally last 3-4, are we still on or have I got logged out?
I just
Okay.
took the
Okay.
screen
Sure.
off, the sharing
Yeah.
screen.
Yeah. So in the last 1 week or so, crude has thankfully again corrected from $96-97 the Brent, which it reached to below 90, 87, $88. So that's a very positive thing. Otherwise, that's a challenge that for India, indirectly it affects us these days in the news flow of so many things, this and that, and positive and negative. These things don't get noticed, but that's something that inherently affects us in terms of increased raw material cost, in terms of impact on currency, in terms of impact on deficits, etc. So I think it will be more like probably the market will continue to remain range bound in the short term. Result season is over, which was expected on the expected lines, as we have discussed in great detail. There are no immediate short term monitorables. Again, we will have second week of January, result season is starting. Pending that, something to be watched out will be the consumption trend, specifically in rural.
Well said, sir. I will add to it is more that Senora believes that over the next 2 years, 2.5 years, we'll see a huge appreciation in the equity portfolio. We believe if invested in the right stocks over the next 2.5 years, you could double your money in equities, driven by both earnings and multiple re-rating. We believe that India will be one of the very few markets where you will have the political comfort, political stability with reforms and earning growth coming from core quality companies, and which is where the investors typically reward. Hence, while barring a short-term hiccup, we are very, very bullish on the market from 2023 to 2025 perspective. Last question of the day, again, a follow-up generally on the Zomato thing. Zomato generally top management and promoter success come after repetitively doing the same thing. But top management is almost left here. Don't you think so? Learning curve will be slow. Two parts to it. I will want to correct it that the people who have left are mid to top management. Last year when Mr. Gaurav Gupta left, and this year with these three guys, all the guys jumped on to Zomato when Zomato started growing. None of them were the core original founders. They gave their sweat and they've contributed heavily to the growth of the business in this expansion phase. But with the expansion done, and probably these guys want to do what they believe in doing, which is expansion of businesses from zero to a level. Zomato has reached that level. Now it is about execution. Probably these guys didn't want it to do that. Be it Mr. Gaurav Gupta, be it these three guys, nothing has come out in the public which shows the differences between the business model and their thought processes. So we will not want to preempt and read negatively between the lines. Yes, these are phases where one should observe very closely, and we are doing that. Zomato, who will exit in future? Any more PE investors you expect? I'm sorry, my friend. We do not are here to preempt moves about others. If you look at the data, this quarter FIA has added more than $1 billion worth of Zomato. Now that's literally more than 10% of the company. So FIAs are adding it rather than selling it. How do P investors look at it? I really don't know. What exit happened recently was the Uber Eats exit, which was a strategic investor which got the Zomato shares because Zomato acquired the Uber Eats business. So that investor was in anyway not a financial investor and was not expected to be there for a long period of time. We do not try to preempt anybody's move. We want to preempt the earnings, and hence stock price will happen over a period of time. And that we have done successfully well, and we want to continue to do that only. So thank you everybody for that time. It was a pleasure interacting with you guys, answering your questions. Kun sir, it's always pleasure to discuss markets and our performance with you. See you all next time till we do our 8th one, which should happen in December. See you guys around. Thank you.
Thank you. Thank you, everybody. Bye.
Bye.